Welcome back to JPX Energy Market Weekly Updates. The recent Red Sea turmoil, which is part of the spillover effect of the Israel-Hamas war, has upended seaborne oil trade through the strategic waterway and sent ripples through the global maritime industry. This week's video does not aim to analyze how Middle East geopolitics evolve over time, but to provide some basic market background and explain the impact of Red Sea turmoil on global oil market. The Red Sea is a critical maritime corridor connecting the Mediterranean Sea to the Indian Ocean via the Suez Canal, creating the shortest shipping routes between Europe and Asia. Sanctions on Russian oil beginning in early 2022 has shifted global oil trade patterns and boosted the importance of flows via the Suez Canal. As much as 8.2 million barrels per day of crude oil and oil products traversed the Red Sea in the January to November period last year, according to an analytics firm Vortexa. That is up from 6.6 million barrels per day throughout 2022. Of this 8.2 million barrels per day, 2.9 million barrels per day is traveling northbound, 3.9 million barrels per day is southbound, with the remainder as imports and export contained within the Red Sea region. Northbound oil shipments via the Suez Canal are mostly directed to Europe. Southbound flows are primarily Russian oil export to China and India, following the European Union sanctions on Russian oil imports. After a series of attacks on shipping routes in the Red Sea over the past 2 months, the response from most of the major shipping carriers who have their fleet transiting the strait has been to divert around the Cape of Good Hope. The diversion adds between 20 to 45 days to a journey depending on the ship's origin and its destination. There's also a significant increase of bunker fuel consumed. This does not factor the commercial loss of additional time that is taken for the voyage, which in turn locks up the ships for a longer period, thereby reducing the available tonnage to the market. If oil tankers are to continue doing the voyages around the Cape due to a prolonged disruption to shipping in the Red Sea, oil tanker freight rate could face upward pressure. The situation in the Red Sea continues to hold significant sway over arbitrary flows. Europe is again at the center of the shock because of its increasing reliance on seaborne oil products, especially gas oil and diesel from outside the region. In January, surging freight rate has closed arbitrage opportunities for Europe-bound route gas oil cargoes from the east of Suez in short term, while a pivot to U.S. imports has helped Europe compensate for a decline in east of Suez inflows. Analysis has warned that Europe's tightening in supply should be felt through the later half of February and last into March, when falling import volumes, together with a peak refinery maintenance leaves, expose a market already low on inventories. This expectations has translated into substantial increases in European diesel cracks and a deeper backwardation structure of European gas oil future curve since the onset of the year. Looking ahead, it's likely the market will once again be able to adjust fairly rapidly at the expense of a higher freight rate. This will be reflected in higher west and east gas oil or diesel price spread. With still ample supply from the east and Europe winter demand eases, global diesel crack spread is expected to weaken towards the second quarter. Okay, that's all we have for this week. Welcome back next week.